If you were given $100,000 today, how would you invest that money? And what debt would you choose to pay off? Or would you simply go on a spending spree? Which is better, investing or paying off your debt? And in what order do you do it? It's a fun example to imagine because nobody wants to feel the pressure of debt. And I think that we all have that dream of retiring as a millionaire, but how do you get there? In today's video, I'll go over a roadmap that I had used that allowed me to become a multi-millionaire and retire after only working for 15 years after college. And I'll start off by stating that I did not inherit any money, and I paid for all of my college myself thanks in part to the US Air Force. But trust me, I paid my dues. And when I did finally graduate college, I think I had about $9,000 in credit card debt. And truth be told, I picked my first job right after college based on the fact that it was close enough for me to ride my bike to because my car was a piece of junk. If any of this sounds relatable, then I think what I share in this video is going to help you learn from my mistakes and also my occasional wins. And for those of you that have already lived through most of your years of paying off debt, if you had to go back and do it all over again, would you choose to invest or pay off your debt any differently? If so, let me know in the comments below. Before listing each option, I need to recognize that everyone's situation is unique and your financial path will be different from me, your peers, and most definitely your friends. The roadmap that I'm providing, it's more of a suggested guardrail to help you get started or to get you back on track. And because your situation is unique, you may need to shift your investment order to align with your specific needs. That's okay. The information that I'm sharing, it's not an all or nothing path. It's just something to help you get started, to help you realign your finances. And I can guarantee you that I will be sharing a few examples and some details that you haven't seen or heard from anyone else. And to put things into perspective, I graduated just before the recession in 2008. It's not that different from today, and that should give some of you a little bit of hope because somehow I made it out okay. The first item that I'll cover is setting up an emergency fund. And I get it, it's not glamorous. But if you don't have enough set aside to cover at least 3 to 6 months worth of your living expenses, then you risk sabotaging all of your finances. While I was working in the corporate world, every company I was with had rounds of unexpected layoffs. Even big companies like Target and Amazon. If it can happen to them, it can happen to any company. And if you happen to have a family like me, along with setting aside those 3 to 6 months worth of living expenses, I highly recommend that you also set aside enough to cover your insurance deductible for a full year. Some people may say that is a very conservative approach, but people get laid off every day, and people get really sick every day. It can happen to any of us, so you might as well plan ahead. And when you set aside those funds, I highly recommend that you either put them into a completely separate savings account or into no penalty CDs where you don't look at it every day. Psychologically, if you see those funds in your everyday checking account, it's going to give you this false sense of security to spend money that you really shouldn't. And I'll be honest, this was an area that I did really bad at when I was first getting started with my own finances. When I was in college, I didn't have any emergency fund because I was mostly living in debt every day. And unfortunately, during my senior year of college, my mother passed away unexpectedly, where I found myself out of work for 3 months because I chose to look after my father, and my debt quickly snowballed. Does any of that sound familiar? I wish that I would have put more money aside for an emergency fund, but I was young, I was healthy, I didn't think that I had anything to worry about, but I was wrong. The next area I would put my money into is a 401k to maximize the employer matched funds. If you happen to work for an employer that has matching funds for your retirement account, then you should always meet the requirement as a minimum. For example, if you have a salary of $100,000 and your employer matches your contribution up to 5% of your annual salary, then you need to take advantage of that. If you invest $5,000 into your 401k, then your employer also chips in $5,000. This is an instantaneous 100% return. You're not going to get that kind of return anywhere else. It's free money, and you should never leave it on the table. Plus, your contribution reduces your taxable income. So if your effective tax rate is 20%, then you're also saving an extra $1,000 on your taxes. The next item of order is to pay off your high interest debt, which is typically credit cards. But for some people out there, if you have poor credit, then your vehicle loan may be higher than your credit cards. The point is, you need to tackle those high interest debts aggressively. If that debt is 15% APR or higher, then you need to pay it down as quickly as possible. Now, there's a few ways to approach this, and I want to discuss as many as I can. For starters, look at your expenses that you put on your credit card. What can you reduce or eliminate? Are you buying yourself an expensive coffee every single day? Are you going out to eat 10 times a week? Or do you have 5 different streaming services that you don't even really need? One of the hardest things you can do in personal finance is to change your behavior to reduce your expenses. But this is probably more important than any other investment outside of free money. A lot of people have the mindset that you'll always have debt and you only have one life, so why try to change? And if that's how you think, then I hate to be the one to break it to you, but you're probably going to be poor. Do not fall into that trap. Now, if you have high interest debt that you want to get out from, then you need to look at your options for consolidation. You can do this by transferring your credit cards to a low or no interest credit card, but this is only good for a limited time, and you need to be cautious when the intro rate ends because the regular rate may be higher than what you already have. Another option is to get a personal loan for credit card consolidation. This may be hard to get if you have poor credit, but this is a valid option worth pursuing. And one of the easiest things that you can do is call the credit card or loan company and ask them for a reduced rate. It never hurts to ask, and many are willing to work with you. And one of the last options that I'll speak to is working with a debt management company. I Googled a few, and one that popped up was American Consumer Credit Counseling. And they charge an enrollment fee, but they work on creating a debt management plan to help you consolidate your debt and get you on a plan of action to pay off all your debt. When I was in college, I think I had 3 credit cards that were all nearly maxed out my senior year. I was able to move the highest debt card, which was around 17% APR, to a 0% card for 6 months. That gave me a little bit of breathing room so that I could pay the minimum on one of my cards and then aggressively pay off the other. I took the approach of divide and conquer and knock one card off and then the next and then the next until I was free and clear. Now, I'll move on to an item that not many people talk about, but I highly recommend is that if you work for a publicly traded company, then you may have an option for employee stock purchase plan. I consider this option to be free money, and that's always at the top of my list. An employee stock purchase plan allows a person to buy shares of stock for the company that they work for a reduced price. In many cases, it's sold to the employees at a discount of 10 to 15% off. And if your company is healthy and growing, then that 15% discount can really give you a head start on compounding growth. I'm going to change gears slightly, and I'm going to cover an area that rarely gets any attention, and that's the fact that you need to take action to ensure that you're able to make more money from your job. This is by far one of the best ways to have all your areas of investment improve with regards to your 401k match, your employee stock options, and paying down your debt. And let's be honest, who doesn't want to make more money? During my internship in college, I worked for a Fortune 50 company where I was doing research in their HR department. I was tasked with reviewing all of the company's top performing executives to determine the traits, the education, and the roles that set them apart from all other employees. I captured about 100 points of data on each executive, and I ran a regression analysis across all of them, and there happened to be one underlying feature among each of them that had a high level of correlation. And that happened to be duration in job and company. The highest paid and the highest valued employees were the ones with the most diversity in their role. It rarely had anything to do with the pedigree of their college or even if they had a master's degree. Instead, the top earners were the ones that typically changed roles every 2 years, and they changed companies every 4 to 6 years. And from that moment on, I decided that I was going to change my roles every 2 years, and I was going to try to switch companies every 4 to 6 years. And if you look at my LinkedIn profile, you'll see exactly that. In doing this, my salary went up about 5 to 10% with every internal move, and my salary jumped anywhere from 30% to 200% when I switched companies. Let that sink in for a minute. As a completely separate example, when I worked at Amazon, if we promoted someone to a new role, we might give them about a 10% raise. However, as a company, they valued external applicants way more than internal employees, because someone hired from outside Amazon for that exact same role with no experience would suddenly have about a 30% higher salary than that same internal employee that was promoted. The moral of the story: changing roles and changing companies will provide most all of you the largest improvement to your finances. And this is one of the biggest secrets that I can share that's allowed me to retire after only working for 15 years after college. With that covered, I have a favor to ask. If you like my content, I would greatly appreciate it if you'd press the like button so my channel here on YouTube can grow. I'd also greatly appreciate it if you'd consider subscribing so you can be updated with all my latest content. Now moving on to the next area of focus, which is to max out your health savings account, if you have one. I have an entire video dedicated to the ins and outs of health savings accounts that you may want to check out. So I'll only give you the cliff notes today. For starters, you need to be enrolled into a high deductible health plan where the deductible needs to be at least $1,500 per person and $3,000 for a family. An HSA is one of the best retirement accounts that you can possibly have. The contributions in 2023 are $38.50 per individual and $77 per family, which you can put into the savings account, and you can later invest that into stock, mutual funds, ETF, etc. And for those of you that are 55 and older, you have an additional $1,000 catch-up contribution. And you're able to sell and trade the stock that's in your HSA account without any tax implication while it's kept in the account. The money placed into the HSA is pre-tax dollars, and the funds can be used at any time for medical expenses tax-free. And on top of all of that, the money can be withdrawn when you're 65 and older and used for everyday expenses, not just medical expenses. And if you do withdraw those funds outside of medical expenses, then you only pay income tax on those funds. That's if you're 65 or older. If you happen to be younger than that, then there's going to be some pretty steep fees and penalties associated with it. So check out the other video if you want to know what those are. But for everything related to medical expenses, regardless of your age, it will always be tax-free. I'll go over a quick example on why an HSA is so important. Let's say that a person is married at age 25 and both spouses contribute the max to their HSA until they're age 65. Based on the S&P 500 average return of the past 20 years at 8.9%, this couple would have over $2.8 million in their HSA when they're age 65. I made the mistake of not investing in my HSA right out of college. My employer also contributed to the HSA where I didn't even take advantage of all the free money. If I would have known the tax advantages of an HSA back then, I would have put so much more money into it. The next order of investing is to max out your IRA. This can be your 401k, 403b, 457b, or even your Roth. Whatever IRA option that you have, you should max it out. In 2023, the max 401k contribution is at $22,500. And if you happen to be 50 years or older, you can contribute an extra $7,500 on top of that. And the max for an IRA or Roth IRA is at $6,500 or $7,500 if you happen to be 50 or older. I won't dive too deep into this, but 401k and traditional IRA contributions are tax deferred and reduce your taxable income the year that you make that contribution. While the Roth IRA contributions are made with after-tax dollars where all the growth and withdrawals are tax-free. However, there are limitations on your income in order to have a Roth IRA. For today, I'm merely giving you the cliff notes. I'll now move on to investing into a taxable account. This may seem completely out of reach today, but I hope that there's a point where you've knocked out everything else on your list and you can now invest additional money that's already been taxed into things like stock, mutual funds, and even ETF. It is extremely important that you get to this point if you have any desire to retire early. And that's because most all other accounts that we've discussed prior to this are ones that have extreme fees or penalties if you withdraw the funds prior to age 65. And as of right now, Social Security isn't even offered until you're age 62. So if you have any intention to retire early, then you're going to need a taxable investment account where you'll have a pool of money to pull from. For me, a large portion of my compensation from Amazon was in the form of stock. And I also began to invest on my own into a taxable account separately when I was about age 35. And this was an absolute must in order to retire early. Now, if you're anything like me and you have children, then you may have a desire to help them pay for their college. This is where a 529 plan comes into play. The contributions into the plan use after-tax dollars, and currently there are about 30 states that do allow contributions to have some form of tax deduction. The money from the plan can be invested and used towards college, vocational school, and even private school, where the withdrawals are all tax-free. But here's where it gets real interesting. Starting in 2024, whatever money is left over into a 529 plan can then be rolled over into a Roth IRA up to $35,000. This simple little step could set your children up for great success later in life if they don't happen to use all the money in the plan. And after all of these categories of investment, the only thing left is low-interest debt or mortgages to pay down. Many people may argue that investments in CDs, treasuries, and the stock market are going to pay a much higher interest rate, and you should dump all your money there prior to paying down this low-interest debt or your mortgage. And in my opinion, it's all personal preference. Paying down a mortgage is a sure thing, but that same money invested elsewhere will have higher returns if you have decades of life left to live. Overall, a person needs to balance out their life expectancy against their willingness for risk within their investments. As I mentioned at the beginning of this video, this is a roadmap that I had used in order for me to retire early, but this may not be the best option for you. Nonetheless, I hope that you were able to get some value out of today's video, and thanks for watching.